Let me ask you something. Have you ever looked at a stock chart, saw the price going up, and thought, is it too late? Am I about to lose money? Am I just gambling? Most beginners either overthink investing or they treat it like a lottery ticket. But what if I told you you can analyze a stock in 10 minutes without a finance degree, without complicated math, and without staring at 200 charts? Today, I'm going to show you a simple 4-step framework anyone can use. By the end of this video, you'll never look at a stock the same way again. Part 1. Stop guessing. Start thinking like an owner. First mindset shift. When you buy a stock, you are not buying a number. You are buying a tiny piece of a real business. So before you look at charts, ask this: would I want to own this company if the stock market closed tomorrow? If the answer is no, don't buy it. That simple question already eliminates most hype stocks, because investing is not about predicting price tomorrow. It's about owning something valuable for years. Now let's get practical. Here's the 10-minute stock analysis framework. Minute 1 to 2. What does this company actually do? If you can't explain how the company makes money in one sentence, you shouldn't invest in it. For example, when you invest in a fund that tracks the S&P 500, you're owning 500 of the largest companies in America. Simple. If you're looking at an individual stock, ask, what problem does this company solve? How does it make money? Who pays them? If it sounds confusing, skip it. Confusion is expensive. Minute 3 to 4. Is it actually making money? Now we check something very basic. Is the company profitable? You don't need deep accounting knowledge. Just look at revenue. Is it growing? Net income. Are they keeping profit? If revenue is shrinking every year, that's a red flag. If they've never made a profit and are just hoping to someday, be careful. You want businesses that are growing, profitable, or clearly on the path to profitability. Simple rule: growing revenue plus improving profit equals good sign. Minute 5 to 6. Is it too expensive? This is where beginners panic. Is it overpriced? One easy number to check is the PE ratio, price to earnings. Think of it like this. If a stock has a PE of 20, you're paying $20 for every $1 the company earns. Is that good or bad? It depends. Fast-growing companies usually have higher PE ratios. Slow companies should have lower ones. The key is comparison. Compare it to its competitors, its historical average. If it's wildly higher than everything else, slow down. Remember, a great company can still be a bad investment if you overpay. Minute 7 to 8. Does it have too much debt? Debt isn't evil, but too much debt can destroy a company in a bad economy. Look at the debt-to-equity ratio. You don't need to memorize numbers, just compare it to competitors. If this company has 5x more debt than everyone else in its industry, that's risk. You want strength because recessions happen and weak companies disappear. Minute 9. Do you believe in it? This is the part no spreadsheet can tell you. Ask yourself, do I use this company's product? Do I believe it will still exist in 10 years? Is it solving a real problem? If you wouldn't proudly tell someone you own it, don't buy it. Conviction matters because markets go up and down, and if you don't believe in what you own, you'll panic sell. Minute 10, the final question. Here's the final filter. If this stock dropped 20% tomorrow, would you want to buy more? If the answer is yes, you've probably found something solid. If the answer is I'd freak out and sell, you don't understand it enough yet. And that's okay. Understanding creates confidence. The emotional truth about investing. Let's be honest, most people don't lose money because they're dumb. They lose money because they buy hype, follow influencers blindly, panic during drops, invest in things they don't understand. Investing is not about intelligence, it's about discipline. It's about patience, and it's about thinking long-term while everyone else is thinking short-term. Stop what beginners should avoid. Let me save you years of mistakes. Don't chase the next big thing. Don't buy because it's trending on social media. Don't panic sell during red days. Don't invest money you need next month. And most importantly, don't try to get rich in one trade. Wealth is built slowly, but it compounds aggressively. Bonus, the simple alternative. If analyzing individual stocks feels overwhelming, there's nothing wrong with buying low-fee index funds that track the S&P 500. You instantly own 500 companies. You remove the stress of picking winners, and historically, that simple strategy has outperformed most individual investors. Sometimes boring wins. Final takeaway. You don't need 10 hours. You don't need complex charts. You need understand the business, check profit and growth, look at valuation, check debt, trust your conviction. That's it. 10 minutes. Simple, practical, repeatable. The goal isn't to be perfect. It's to avoid obvious mistakes. Because in investing, avoiding big mistakes is often more powerful than making genius moves.